Good morning, everyone, and it's a pleasure for me to be with you this morning. So as my colleague Cameron mentioned, I'm going to now discuss world merchandise trade. And much like the global economy my colleague Cameron just described, global trade is navigating, as you know, very turbulent waters these days. But the headwind it faces are not always the same. And when they often hit merchandise trade more sharply than the overall economic activity. Trade policy uncertainty is a good example. While this issue has moved out of the headlines recently, largely because of the conflict in the Middle East, uncertainty around tariffs remains elevated. Even after the US Supreme Court ruling in February, which constrained the executive's ability to impose tariffs, effective the 24th of February, a temporary 10% import surcharge was imposed on certain articles for 150 days by the US executive. Subsequently, in early March, new investigations under the Section 301 were initiated to determine whether alternative legal instruments could be used to achieve similar results when this 150 days period will have expired. So despite some reassurance from the courts, firms and trade policy makers continue to operate in a highly uncertain trade policy environment. Geopolitical tension add another and more immediate layers of stress as ships and planes arriving and departing from some Gulf countries are facing constraints in physically moving goods. More generally, disruption to key transport routes, but also rising insurance costs and higher energy prices are now directly affecting cross-border merchandise flows. These challenges are further compounded by increasingly divergent industrial policies across major economies, but also by rising protectionism in part of the world and by a multilateral trading system that remains under strain. And the recent disruption in the Strait of Hormuz are a stark reminder of how quickly geopolitical risk can spill over into trade, affecting not only the flows of goods, but also the production worldwide. At the same time, it is important to recognize that not everything has moved necessarily in a negative direction. We have also seen meaningful progress on some plurilateral trade initiatives and in certain cases, renewed effort to design trade policy that better support the most vulnerable economies. And my colleague Dawei will come back to those developments later this morning. Taken together, these evolving risks and opportunities matter particularly for merchandise trade. And for this reason, I will focus my remark today on trade in goods, leaving aside the services dimension. The key message to keep in mind as we go forward is a simple one. Merchandise trade has shown more resilience than expected, but that resilience is narrow, uneven, and potentially fragile. So to delve into this topic, I'll start by reviewing some recent development in world merchandise trade by looking at the data. The figure on this slide shows monthly seasonally adjusted level of merchandise export on the left and import on the right, with a breakdown between advanced and developing economies. So the first point to emphasize is that merchandise trade remained remarkably dynamic throughout 2025, and this was, frankly, a positive surprise given the many headwinds trade was facing at the time. As the UNCTAD Secretary General put it, the worst-case scenario anticipated at the beginning of 2025, which is a sharp contraction in trade, simply did not materialize. Yet, we are not out of the wood at the moment. According to UNCTAD preliminary estimates, global merchandise trade grew about 4.7% in real terms in 2025, This is a strong outcome, especially when you contrast it with the global economic growth of 2.9% that my colleague Cameron just mentioned. In other words, merchandise trade has outpaced overall economic activities in 2025, and that was remarkably that stand out compared to the previous year, but that was not necessarily the case. In the first half of 2025, a significant part of this momentum was driven by a temporary factor, which is the acceleration of the US import in response to tariff uncertainty. So you have firms which front-loaded purchases to hedge against possible trade restriction, and that's a dynamic we already discussed in the Trade and Development report last year, and as expected, this effect faded over time. But beyond that temporary boost, more structural forces were also at play. We have several large developing economies, mostly in Asia, that recorded relatively strong growth, and as a result, their import demand expanded as well. This supported the expansion of South-South trade, which today accounts for a share comparable to trade among advanced economies. And again, my colleague Daiwei will return to that point later on. Another point that deserves a special attention and that we could not fully explore at the time our flagship publication was released is the rapid expansion of cross-border trade in AI-related products. And this segment of merchandise trade has grown far more quickly than most others, and it has become a key pillar of recent trade resilience. And I will come back to this in a more detail later in this presentation. For now, it is important to emphasize that merchandise trade growth in 2025 was not broad-based. Instead, it reflects a very strong performance in a limited number of sectors, particularly in technology, alongside much more subdued dynamics elsewhere. Turning to early 2026, the aggregated pattern we observed last year continue or even strengthen. For instance, to give you a few numbers, we have, if we look at international air cargo volumes, they grew about 7% in January compared to their level a year earlier. And for February, that growth was reached 12%. At the same time, if we focus on global seaborne trade, it expanded by more than 5% during those 2 months, with particularly strong growth in specific segments such as car, grain, or liquefied natural gas. Now, overall, world merchandise trade entered 2026 on a relatively strong footing, especially for developing countries. By contrast, import demand in advanced economies, and that's the yellow line that you see on the right panel, has remained much flatter, and aside from the temporary boost we observed in the United States in early 2025. So this contrast between developed and developing economy will be the focus of the next slides. And I will now zoom in on developing country and look more closely at the regional dynamics. So the main takeaway of that slide is that exports from developing countries have continued to trend upward, with particularly strong momentum in Asia. By the end of 2025 and into early 2026, early custom data point to a solid export performance supported by strong containerized flow on key Asian and Trans-Pacific route. And these logistic indicators are consistent with the broader picture of resilience we discussed a moment ago. To give a concrete example, Chinese export expanded very rapidly at the start of the year, by more than 20% in dollar terms in January and February 2026 compared to the same period a year earlier. Last month in March, Chinese exports slowed markedly to around 2.5% year on year. This might look like a sharp deceleration, but in fact, it largely reflects a payback effect after the exceptionally strong start of the year. Importantly, high technology export continued to expand at a much faster pace even in March, suggesting that the underlying strength in technologically intensive sector remains intact. And so far, it is still too early to see a clear export drag from the conflict in the Middle East in the export data. That said, we can already observe an impact on the import side, where rising energy prices have pushed up import bills, and this has contributed to a narrowing of China's trade surplus in recent months. More broadly, when we compare export and import, one feature that stands out is the trajectory of Chinese import. And this matters a great deal for other developing countries, given China's central role in South-South trades. So that's the light blue line on the right panel. In relative terms, Chinese import growth has been quite subdued over the past 2 to 3 years. However, as you can see from that figure, in early 26, we see a clear rebound, and if it's sustained, this will provide an important source of demand or additional demand for other developing exporters. In short, the data suggests continued resilience in developing country trade, driven in particular by Asia, but it also points to emerging vulnerability linked to energy prices and geopolitical risk. Now, let me now turn briefly to development in developed economies and contrast them with what we have just seen for developing countries. So starting with imports, the picture is fairly clear. Import demand across most advanced economies has remained subdued. The main exception are a few Asian advanced economies and to a lesser extent the United States. Elsewhere, import growth has been weak, reflecting softer domestic demand and lingering uncertainty. When we look at export, the pattern is broadly similar. Export performance in most developed economies has been relatively flat. One notable exception is the United States, which has managed to regain some market shares in the post-COVID period, at least relative to its European and Japanese competitor. And taken together, this trend carries an important implication from the perspective of developing countries. So developed economies remain a major destination market for developing countries in export. That has not changed. However, when we look at where global import demand growth is actually coming from, the picture looks different. Increasingly, it is developing countries themselves, and to a lesser extent the United States, that are providing most of the momentum. As a result, the export prospects of developing countries are becoming more closely tied to demand conditions in other developing markets, and this reinforces the growing importance of South-South trade and regional demand dynamics, but it also means that shocks affecting large developing economies can now have much broader spillovers. In other words, while advanced economies continue to matter a great deal, the center of gravity of import demand in the global trading system has shifted, and that shift has important implications for trade resilience and vulnerability going forward. This changing demand structure also helps explain why the composition of traded product and not just the destination has become so important, which brings me to the next slide. So far, I have focused mainly on where trade demand has been coming from. Let me now change the perspective slightly and look at what products have been driving recent development in world merchandise trade. As I mentioned earlier, one of the striking features of the past years is how concentrated trade growth has been. And the recent expansion in international merchandise trade has not been very broad-based. Instead, a relatively narrow set of products has accounted for a disproportionate share of the overall growth. In particular, AI-related goods such as servers, high-performance computing equipment, semiconductor, and components linked to the automation and data center investment have played a crucial role. And in several economies, especially in East Asia and North America, these product categories have recorded exceptionally high growth rate, sometimes in double or even triple-digit terms year on year. So to illustrate this concentration, the figure on this slide focuses on one single product subcategory of the HS six-digit classification, which is the automatic data processing machine. So it's what you see, one example is what you see on the right part of this chart, which is the towers of servers and all that. And what is striking is how large its contribution has been, given that this category is only one among more than 5,000 entries in the HS six-digit classification. So in the United States, for instance, import of this category alone accounted for around 3/4 of the total nominal growth in merchandise import in 2025, which altogether reach about 4%. In China, the strong import of this product almost entirely offset the net decline recorded across all other imported goods combined. And in Japan and in Europe, this contribution of this product is smaller, but still far from negligible. And for this, so far, we could only do the calculation on a subset of countries, I mean the large economies that you see here, because we are still waiting for the a more comprehensive data for the world as a whole to perform that overall exercise. But this brings me to a key point, which is that the recent resilience of global merchandise trade rests heavily on a very narrow engine of demand, and that raises an important risk. If the current momentum around artificial intelligence were to fade, either because expectations prove too optimistic, or investment cycle peak, or a broader market correction takes hold, this engine could slow down quickly. And given that AI-related products have been one of the few strong drivers of trade growth in an otherwise fragile global environment, a sudden cooling will likely pull overall merchandise trade growth down sharply. And this is why diversification matters. Strengthening demand in other sectors and broadening the source of trade growth will be essential to make global trade more resilient in the period ahead. Now, let me conclude my intervention by looking ahead. In the current context of persistent uncertainty and elevated geopolitical risks, combined with a fragile aggregate demand in several large economies, we expect the relative resilience of merchandise trades observed in 2025 and early 2026 to come under increasing pressure as the year progresses. The evolving conflict in the Gulf is likely to be an important part of that stress test. And more broadly, when we take into account the expected slowdown in global demand and the likelihood that the recent boom in AI-related investment will gradually normalize, our assessment is that world merchandise trade growth is set to decelerate in 2026. In real terms, it is expected to slow from 4.7% in 2025 to a range of 1.5 to 2.5% in 2026. And I will stress that these estimates carry wide uncertainty bands, reflecting not only the geopolitical risk, but also the narrow concentration of recent trade drivers we discussed earlier. Beyond 2026, rising geopolitical tensions are likely to accelerate the reconfiguration of global merchandise trade. Some element of this reconfiguration are already taking shape throughout shifting trade partnership, strategic industrial policy, and growing regionalization, but the overall direction remains uncertain. For firm and governments alike. This implies a more volatile trading environment with fewer stable anchors and greater exposure to sector-specific and geopolitical shocks. Strengthening the resilience, diversifying source of demand, and managing transition risk will therefore remain central challenges moving forward. With that, let me now hand over to my colleague Daniela, who will discuss recent development in capital flows and financial spillover from the Gulf conflict. And after that, we will have a time for first round of questions before my colleague Dawe comes back to recent regional and sectoral initiatives that will also shape the future of trade. And I thank you for your attention.